So the interesting thing about broad money is there's unintuitive things about how it's created and destroyed. And something we covered quite extensively over the past couple of years is the two major ways to make new broad money. One is that banks lend it into existence, and the other one is that the government can run large fiscal deficits that the central bank monetizes. Basically helicopter checks that are paid for by the Fed, essentially. And those are the two main ways to substantially increase broad money supply. And then so the question becomes, how would you destroy broad money supply? And you have essentially the reverse of one or both of those things. So either the government is running large surpluses and taking money out of the economy, good luck. And then the other one is loans are being destroyed. Either they're being defaulted on or paid down. And so they're basically that's a way to destroy broad money. And because we don't see either of those two things happening, we're not seeing a downward move in broad money supply. We're seeing a slowing growth of broad money supply because we're not actively sending out helicopter checks anymore. But we're still seeing, and we've had kind of a mild contraction because there's variables around the margins that can affect money supply. But basically, we got all-time highs, and then we've been chopping along for a period of time. So all that money is still in the system. If someone had their checking account boosted up and then they spent it, that money doesn't disappear. It's going to someone else. And then they receive that extra money, and the question is, what do they do with it? And if they spend it, it goes somewhere else. So it either keeps circulating or it ends up being hoarded somewhere. Someone, unless either loans are being paid down or the government is sucking money out of the system with fiscal surpluses, that money is it's permanently in there now. And so that's the way I'm kind of analyzing it in terms of, if you go back to the 1940s, you had these huge inflationary spikes, but then when the inflationary spikes were done, you had these plateaus where there's now permanently more money in the system and the aggregate price level is now permanently higher. That doesn't mean that there can't be pockets of things that might have gone down. I mean, if the government needed a ton of copper for the war and then copper spikes and then they don't need that copper anymore, you could get a collapse in copper prices, for example. That's like, one specific thing, but the aggregate price level is higher. And so the way I've been phrasing it in this environment is like, Chipotle did price increases and wage increases, and those are never coming back down. We're not going to see a reversal. We're not going to see negative inflation among a lot of these kind of permanent price increases. You can see it around the margins of certain commodities or certain pockets of things that maybe spiked way too high due to bottlenecks. But I think the broad level is permanently higher because there's permanently more money in the system. And essentially what it comes down to is each unit is worth a little bit less. So if you were to look at those checking accounts, but then you say you redenominate those in how many gallons of gasoline does that person have saved up, right? Or how many, what is their ability to buy a house, right? So I think when you do it that, you'd see a smaller increase, right? Because gasoline prices also went up quite a bit since 2019, and so did the median house price and things like that. So they have, in some ways, not a huge stockpile of extra ability to buy things, even though they have a much higher stockpile of cash. But it would come down to specific numbers. But yeah, I think that's still in generally an inflationary force, or at least a force that prevents an absolutely sharp decrease in prices back down to say prior levels, because all that money is still out there. I think you'd see a one-time increase in prices, and therefore if you ran average inflation over that decade, it'd be pretty high, but it would have been all concentrated in a pretty brief period, right? So after that, you could get a pause in rates going up. Prices going up. Now I think in reality, it'd be messier than that because it does take time for that to trickle through. So if everyone got $1 million in their account, some people run out and buy stuff right away. You start to get empty shelves and too much demand relative to supply until price started adjusting upward to reflect the fact that there's more money in the system and that demand is overwhelming supply. And then you'd eventually find like an equilibrium where we've essentially debased the currency enough that things kind of return to normal, but that everything is priced higher now, or at least most things. So I think, and then it would come down to the only thing that would make it keep going up is if there was like some sort of ongoing, like if people lost faith, if they're like, oh, they're just going to do it again, and then say the entire international community wants to sell that currency because they're like, what's from stopping them from doing it again, right? So you could get some sort of nonlinear confidence sea change for international demand for that currency that could cause a more persistent inflationary pressure. But as kind of a localized thought experiment, yeah, I'd go more with that one-time plateau, higher prices. So I've run some data on this over like say 120-year period, and there's very strong correlation between oil prices and inflation, particularly in say rate of change terms. And so the way I like to look at it is in these 5-year rolling increments, because one year is very noisy.
Yeah.
But if you chart out say 5-year cumulative CPI growth and 5-year cumulative oil price changes, you'll see that oil is more volatile than CPI, but that it's very strongly correlated. You get these huge spikes in oil, and that results in a significant increase in CPI. The biggest exception was the 2000s decade, where you had the level of oil price spike that we got in the data should have contributed to more CPI and didn't. And part of that is due to how we changed CPI, but a lot of other was real. And there was a unusually large decoupling there. And my view is that was because of globalization forces, right? So that was kind of at the peak rate of when we were like aggressively sending jobs to China. Basically, we were opening up this whole new world of untapped labor. There was all this extra supply for labor and manufacturing and things like that. And so there was less domestic wage pressure, and less other kind of, basically we had an unusually big disinflationary impulse to offset what would otherwise be a very strong inflationary force. But you still had a positive correlation. It was just a much weaker correlation, or at least a weaker, a bigger decoupling in terms of magnitude. Um, but I think that, my base case in the 2020s is we get another kind of increase in oil prices, and that this time we don't really have as much disinflationary offsets as we had during that period of peak globalization. Another way to phrase it is that if you look at, say, oil prices are denominated in gold over the very long term, it's kind of this big zigzag pattern. You're just, an ounce of gold can buy about as many barrels of oil as it could many, many decades ago. You have periods of high oil prices if there's, constraints on supply. You have periods of low oil prices if you're in like a recession. But in general, you're just kind of chopping along in this big volatile range sideways. Whereas if you look at oil price in dollars or any other fiat currency, you get more of like these like permanently higher plateaus every couple decades. So generally in those inflationary decades. So you got a big stepwise change up in the 40s, another big stepwise change up in the 70s, another big stepwise change up in the 2000s, and then once you have that kind of new period and not a lot of supply comes online, you generally get these more disinflationary, sideways to down trending periods at this new higher normal, until you run into the next capex and demand cycle. So that's
Yeah.
generally how I see oil markets.